Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to another edition of our podcast, Real Estate 360 Live. For those of you not familiar with our program, our guest and I will cover everything under the sun about real estate. We'll cover the national landscape as well as breaking it down more on a local level. Obviously, I'm located here in the D.C. metro area, so I will put things into perspective for the D.C. metro area. Obviously, it's going to be a little bit of a different dynamic than the rest of the country. But we're actually going to go in and tell you what's going on behind the scenes, what the Fed's doing, the manipulation of interest rates. And I think it's really important for people to, when you're making a buying or selling decision when it comes to selling or buying a home, that you understand why you're doing it, what the potential implications in the future of what the Fed and the government and everybody else is doing, how that can affect your home price, how that's going to affect mortgage interest rates if you're going to buy another house after you sell that house. We talk about all the economics behind things that, most people don't want to discuss but are important and relevant. If you guys haven't checked out yet, we are located on iTunes. If you go to the iTunes store, you can type in Real Estate 360, and you can download the podcast there. You can also go directly to the website if you want to stream it from the website at realestate360live.com. On the right-hand side, there's an Ask a Question button. That's where many of the listeners actually go to ask questions. When you guys put questions in there, it actually helps because when we do future shows, we will cover topics that you request. I think that it is important that we answer all of your questions, especially when it comes to dealing with complex issues such as the Fed and the artificial manipulation of interest rates. I know we talk week in and week out about this stuff, and sometimes, it might go a little over some people's heads if you haven't been following this. So if you need, us to further break down these issues, we have no problem doing so. Joining me on our panel, as he does every week, is Louis Camerasano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. Louis is often cited in the media as a real estate industry expert. He's been cited in the Wall Street Journal, Forbes, Wall Street Journal, Fox Business, U.S. News, MSN, and numerous others. Louis, how you doing today, buddy?
Doing grand, Ryan. How are you today?
I'm doing well, sir. So it's good to have you back again.
Excellent. Good to be here.
We've had, not as much going on in the markets this week. A lot of our show last week was really, talking about the Fed and the potential for them to taper off their purchases of mortgage-backed securities and or Treasury bonds. They're right now buying $45 billion in Treasuries every month and $40 billion in mortgage-backed securities. Me and you always have great email, back and forth between, what's going on with these articles that have been in the news over the last week. And, last week you had asked me if I thought that there was any potential for them to taper in December, and I said absolutely not. I still feel very strongly that that's going to be the case. Obviously, we had this week the initial jobless claims, which came in worse than expected, which I was waiting for that kind of bombshell to drop with all the positive economic news that we've had over the last 2 weeks, that at some point there had to be something that slowed this down, because the Fed has to know that if we keep getting all this positive economic news, they're going to force our hand to do something. So now that we have a negative economic report, so it gives them the ability now to say, well, hold up, guys, it looks like it's not as good as what we thought it was. Let's wait a couple more months. It seems as though many of the analysts, whether it be on Wall Street or just regular business shows, are predicting that the taper is going to take place in the next month. Louis, you and I talk about this ad nauseum, but what are your thoughts now? Obviously, we've heard that, the government, the Republicans and the Democrats, it looks like that they're going to strike a deal. There's not going to be a government shutdown. And knowing that the Fed was, pretty much carefully paying attention to what was taking place there, they now know that there's probably not going to be a shutdown. We know that, Bernanke is going to lose his post come January. What are your thoughts moving forward now as to what's going to take place in December and moving forward from there?
Ryan, I think it really doesn't matter whether they taper in December, whether they do it in March, because whatever taper they do will be an experimental taper. I think I think that they actually can sneak in a taper just to see how the market would react, because they know they can always turn around and double down and try to undo the impact of the taper. I think that the economy is reliant upon quantitative easing. I think that they need to continue to do it because that's all they know how to do. That's what the housing market is based upon. That's why the stock market is up. But they also need to regain some credibility that they've been talking taper for 5 years, basically, and have accelerated that talk in the last year, that they have to kind of do something. And the reason I think it's okay from their perspective, I think they should stop QE altogether, but the reason they can taper is you have to keep in mind it doesn't mean that they've stopped expanding their balance sheet. They're just expanding it at a slower rate. They're still, if they did do a taper, maybe they cut back $10 billion worth of mortgage-backed securities, or 5 and 5 on the U.S. Treasuries and the mortgage-backed securities. They're still buying these securities out of thin air with money printed out of thin air. So it really isn't going to impact much at all. And like I mentioned, they can always turn around and re-up it. If they don't taper in December, and then they're basically never going to do it. And that problem, though, Ryan, is then they lose even more credibility, because if people realize, if they don't taper, that QE is a permanent feature of the economy, you'll see more damage to the dollar, and interest rates will rise irrespective of them not tapering, because people will realize that they really are bent on debasing the dollar by doing QE. So I'm not predicting a taper. I still think it's 50-50. There's arguments that they are going to continue it forever. That's their only choice, the only thing that they can do. But I think in order to kind of regain some credibility that this isn't going to go on forever, they might want to try to put one in there, because they've delayed it. One of the things that did hurt them, Ryan, if you remember, back in June, they said they might taper. Interest rates basically doubled on the 10-year note. And then they pretty much convinced everybody they were going to do it in September. Then they didn't do it. That kind of surprised a lot of people. October, they didn't do it, and they had a built-in excuse. Well, there's this budget wrangling. We can't do it then. Now they're getting people prepared again to do it in December. They might be able to pass it off and then try it again in March. But at some point, they are going to have to do some type of at least ceremonial or for show type taper, just to keep the markets honest. Because if they don't,
it's going to be damage control.
Yes, but there's going to be damage control if they're basically the Fed that cries wolf and keeps saying, "Oh yeah, it's just coming around the corner. We're going to taper. We mean it this time. Oh yeah, taper." So and the data does give them always some kind of out to either taper or not taper, because like you saw yesterday, we had the jobs report kind of threw a monkey wrench in the whole narrative that somehow the job market is doing better, when then all of a sudden you have all of these initial jobless claims. But at the same time, you also had a report yesterday where spending was up. And Wall Street loves spending, so if people are spending, and if they don't have jobs and they're spending money they don't have, that's a good thing. So maybe they can taper. I really think they're going to have to pull the trigger, even though they know they can't. It's just that at some point they lose credibility if they don't pretend that QE isn't forever. But you still think that they're not going to do it? Absolutely never. Not in December, not in March.
Okay, so here's my thoughts. And first, we talk taper all the time, so I'm going to break this down again on an elementary level for everybody that's out there that's listening to us for the first time. If we had normal markets, interest rates right now would not be in the 4% level. They'd probably be 6, 7, 8% if we had free market. The Fed has came in and noticed that they were trying to stimulate the economy, and they thought by keeping mortgage interest rates low, and the way they do that is they go in and they physically buy mortgage-backed securities, which puts downward pressure on interest rates. The Fed is basically the one that's buying up 70, 80% of all these mortgage-backed securities right now. So in a normal market,
and U.S. Treasuries.
And U.S. Treasuries. So if they were not buying these things right now, we'd have interest rates through the roof. Number one, mortgage interest rates would be, like I said, 7, 8, 9%. Who knows where they'd be at right now? And we wouldn't be able to basically pay the interest on our debt, right?
Correct.
Because the interest
or even borrow the money because the excess money that the government spends over the amount that they raise in taxes is funded by purchases of U.S. Treasuries, but the demand in the real market isn't there, so the Fed buys up 70 to 80% of those.
Yep. So, by them doing this, they've created a completely artificial market, and we've had and that's why it's not just, the stock market that I consider artificial. The real estate market's artificial. These aren't real markets because it's actually proven when they show these GDP numbers and how the economy is actually growing. I mean, real estate is a pretty big component of that, but it's not actually done what they thought it was going to do because the biggest component of all of this is that the employment is crap, and people are losing jobs left and right. They keep saying the unemployment number is coming down. It's actually going up. The real unemployment number that I care about is going up. So when we're talking taper, all we really mean is that instead of them buying $40 billion of mortgage-backed securities, if they changed and they went and then bought $35 billion, what that's going to do is signal to the markets that, whoa, okay, well, where's the private investment going to come from to buy up the other $5 that they just let go? Well, it's not going to be there because there's not an appetite for that stuff right now. So naturally, interest rates are going to rise, okay?
Which would attract appetite, though, Ryan.
Which would at higher interest rate levels.
Correct.
Right? So then we have, and this is why there's a big picture thing going on here because we have a lot of stuff taking place all at one time. So the beginning of January, Lewis, qualified residential mortgage rule takes place, right, where basically all loans that Fannie and Freddie are backing and FHA loans more than likely are going to have to be, your debt-to-income ratios, if you're qualifying for a loan, can't be higher than 43% of your income, which before was 45% or 50% or even higher, depending upon what type of loan you were taking out. So they're already projecting that about 20% of the loans that we're getting approved now they're going to fall right off. So we have that. We have FHA loan limits, which are being lowered, okay, to come the beginning of next year in January. And in a high-cost area, such as the D.C. metro area, that was over $700,000 for loan amounts, are going to be reduced down to $625,000. That puts downward pressure on price, okay? So we have that. Then we also have Harp 3.0, which I think is hilarious. Have you heard about the Harp 3.0 program, Lewis?
I've heard of it. I don't know the details.
Okay, so it's exactly like Harp 2.0 and Harp 1.0, except they're trying to make it so that now people that don't have loans owned by Fannie and Freddie, they can actually still get those same refinances if they're upside down on their house. Okay?
That was the one complaint you had about the
Absolutely. That was the one thing that right out the gate would have basically, instead of helping like 3 million people, would have helped like 10 million people, right? Because everybody was in that situation. Well, the irony about the timing of them trying to push Harp 3.0 through is that interest rates have now risen. They had no benefit to create this program when interest rates were in the 3% to help everybody. We can't give the whole world 3%, right? So now they want to roll these things out. It's the timing of everything that I think is so interesting. So will the Fed taper moving forward? I kind of feel like they can't, but I do put a lot of stock in what you say that they've lost so much credibility. But my fear is, okay, let's just say, and it's not in December, it's in January, they taper, and they said, let's just peel off $5 billion instead of 40, we'll do 35. We know that there's the lag effect that takes place anytime that they do anything with interest rates and or employment situation, as we saw with the government shutdown, right? So we're not going to find out what the effects of them doing that in the actual marketplace, in the real estate market, for probably 6 months from that point. And I think that if they do that, and then all of a sudden they're like, wow, we just completely slowed up the real estate market even further than we thought. Now what do we do? Then
they talk it down. I mean, after they do their taper, they start talking about how they're not sure if they're going to continue it, they're going to wait and see, and they can pretend they're going to taper for the next 6 to 8 months and not do it. And then when the data comes in, if it's bad, they can continue printing more money.
Well, my thought is, too, is that we know that the biggest banks are comprised. They're the ones that are sitting down at these Fed meetings anyway. I think that they might be the ones that step in and buy these mortgage-backed securities if necessary, right? I think that there is going to have to be some sort of private appetite to make up this difference. And I don't know if we discussed this before, Lewis, but so this whole qualified residential mortgage rule, it is a very big deal because it basically changes the ability of people being, to get qualified for a mortgage. As if it wasn't difficult enough before, it's going to be more difficult now. And if we have rising interest rates on top of it being more difficult to qualify for a loan, that's going to put extreme downward pressure on the house price, correct?
So, absolutely. But I think what they're doing is they probably might give up on real estate because there's a limit to how much you can boost real estate. There's not a limit to how much you can boost the stock market. People can pay $2,000, $3,000, $4,000 a share for a stock. There's a limit to the housing, and if they realize that the labor market isn't that good and that home prices have risen enough, they may decide that they can allow interest rates to go up a little bit as long as they can talk them down and continue to boost the stock market. Because they can claim the reason interest rates are rising is because the economy is doing better. They can play that nonsense that somehow they're not rising because the Fed stopped buying U.S. Treasuries and mortgage-backed securities, but the interest rates are rising because the economy is getting better. And they can play that up.
Yeah, I agree. I agree with that. But I also think that, we still basically have about 1 in 4 homeowners nationally that are underwater. They're still not in good positions. And I think a lot of what they were trying to do by boosting up the real estate market was to give people a sense that things are going well because
absolutely.
People have home equity. They feel
But Ryan, how much more QE can they do, and to what effect would it have, and how many years would it take to get that remaining 20-25% of homeowners that are underwater back up? And then they really risk a real collapse if they push the housing prices up that high.
Yeah, well, I'm thinking, in the D.C. metro area, I mean, we've made up substantial ground just in the last year.
Remember, Ryan, it's ground back to the old glory days of 2005.
Exactly. Right. So but what I'm saying is we made up ground from basically what people are upside down right now, right?
Right.
So let's say that they're upside down right now by 10%, where last year it was only 20%, and they're only upside down now by 10%.
Right.
It would make sense that, prices over the next 2 years or so could make up another 10% or so. But why I find all this interesting in the timing of Harp 3.0 is because if what you're saying holds true, Lewis, and they do plan on getting out of real estate, or they're not just going to be as focused on it, that Harp 3.0 program where you're basically allowing them to go in and refinance their loan, and it doesn't matter whether it's owned by Fannie or Freddie, would give people now that ability to refinance, right, at the going rates, which aren't as good as they were, but they're still probably lower than they had, which would then make people happy all over again, right? I'm at 6 now. You're going to give me 4.5. That's a great deal. I'm not necessarily worried about me being upside down anymore because you just lowered my rates. Right. So I think that there is all these things coming together at the same time. It's no coincidence, I'm sure. It's absolutely no coincidence. This is, the Federal Housing Finance Agency, the Fed, Congress, all of them are in on this. They know that there's got to be some sort of master plan that's derived here. So I think, it is a possibility, Lewis, that they could taper. I really don't know how the markets are going to react to that because I've seen how they've reacted in the past.
Right, but nor do they. And I think until they know, it's probably worth the experiment to toss a small taper on the table.
So what are your thoughts if they toss a small taper on the table and interest rates rise from let's just say like 4.5? I'm just making these numbers up, 4.5 to 5.5. What happens?
Well, then there's general panic, perhaps, or maybe there isn't. If there is panic, they come out and they do what they do after they do every announcement, is they have each Federal Reserve governor fly all over the world, give some kind of talk about how tapering in the future is not assured. They may not do it anymore. It all depends on the data, and everybody will calm down and think, oh, that was just a trial balloon that they floated. And if things continue, the rates continue to rise and the market continues to go south, they won't do any more tapering, and perhaps they'll reinstitute quantitative easing. They can kind of get away with it because people do listen to what they say, and They can undo a taper pretty quickly by just yakking it back down and saying, we were just testing the market. We didn't realize, the extent, and then you can have further bad economic news come out, which will mean there'll start to be rumors of an increase in the taper, and then everything will get back to what they consider normal. It's difficult, Ryan, because as you and I mentioned, they need to stay in the middle, and we're in a very extreme economy, so they can't allow things to go too far in one direction. And I believe right now the sentiment is so far against them. It's is so in favor of them tapering right now that if they didn't do it, the sentiment would swing so far the other way that these guys really are bluffing,
right.
and that QE is permanent, and they don't want that perception.
Right.
They want to play the nonsense that we're not going to, well, we did, but we're not going to do it again. We might do it if the economy gets worse. We might not. They want that back and forth. But if they don't taper, at some point, they won't have the back and forth. People will just be convinced that it's taper off.
Right.
And they're just going to print forever. They can't have that dynamic. And you and I never thought they were going to taper all year. And we made that prediction at the very beginning of the year. And we said they were bluffing all year. But the market was believing the bluff. They believed it in the summer. They believed it in September. They kind of believed it in October. They believe it again in December. If they don't do it, then a lot of people are just going to start to move to our camp and start to think the Fed is just going to do QE, and the Fed never wants that complacency. They want people thinking it might come, it might not come. And the only way I think they're ever going to keep that dynamic going is at some point, doesn't have to be December, but it probably has to be at least March, they have to try one on for size just to show that they're not bluffing.
And then they can play the card, hey, look, we tapered, but obviously if we weren't ready to taper. We need to actually,
right.
Yeah, we need to go back now, and now we need to raise up our QE. But then they can justify why they're doing it because they tried something and it didn't work, right?
Right.
Yeah, and I can see that. You know, the whole reason why I keep saying that I don't think they're going to taper and it's not going to happen is because I've taken the stance that I'm going to make the Fed prove me wrong, right?
If the economy's doing well, go ahead, taper. See how that goes.
Right. They haven't held to their word yet, so I'm going to continue my stance that they're not going to. That doesn't mean that they won't, but it's just we have a track record of over 5 years now of them really not doing much for the economy and not really doing what they say they're going to do. So I want them to prove me wrong.
Well, here's another thing, Ryan. I want your thoughts on is you and I and a lot of people. Back in 2009 and 10, when they started QE, were very upset because we called it money printing, it was inflationary, it was an artificial interference in the market, and it basically is not sound economic policy. Okay. At the same time, we also criticized the federal deficits. The stimulus program added billions, hundreds of billions of dollars to the budget. Deficits kept increasing. And, during that time, the Tea Party was born against the backdrop of this increasing deficit and so on. What we've seen now, though, Ryan, the last budget battle was the last stand where Republicans, or a certain portion of them, were saying we can't raise the debt ceiling and, we have to get our fiscal house in order. It seems now, Ryan, that the most recent budget negotiations have yielded, you know what? Let's just not worry about that for another 2 years, and we'll cut spending over the next 10 years, but not the next 2 years because we don't want any kind of budget battle. So, Ryan, it seems like there's this complacency that QE is fine. Hey, you could taper it, but, we have to keep that going. And fiscal policy is let's not rock the boat now. We've got elections coming up. We upset a lot of people by closing the national parks last time. Let's just keep spending money.
Yep. Well, it's the politicians fight very hard for what they believe in or what they're trying to get accomplished in the first 2 years, and then now basically the Republicans see that they didn't get anywhere, and they actually screwed up when the last shutdown happened because they weren't arguing what they should have been arguing and focused on other things. And now they're like, well, we can't be seen as the ones that create another government shutdown because of the next election, right? That's the whole thing that's going on here. We want to be seen as the peacemakers here. So then the next election, only thing we have to worry about is just basically slamming Obamacare, okay? And that this was a failed mess, and that's going to be their whole election is run on that, right?
Yep.
We can already see that coming from afar. It's a complete joke. I mean, we knew that they weren't going to create a real budget. Why? Because they don't know how to cut spending. They don't.
Right. Well, just like the Fed doesn't really know how to start to taper and stop the printing.
I know.
But the difference is the Fed has to regain some credibility. Congress is even just as immune as the Fed is. People don't vote those people out.
No, absolutely.
In fact, they vote them out more if they shut the government down because they tried to stop spending.
But that's my question to you then. Okay, so we don't vote those politicians out. So even if the Fed doesn't taper, what's going to happen to them just because they lose credibility? I mean, how long is it going to take before something actually happens?
Well, the difference is if the Fed loses credibility that they're never going to taper because they don't taper in December and they don't taper in March, they'll lose the credibility they need to control the bond market, and interest rates will rise irrespective of whether they taper or don't taper or say they're going to or not say they're or don't. What they need to have is the ability not just to move the markets by their policies, by people actually listening to them when they run around and the Fed presidents start yakking after and before and during the meetings about what they may or may not do. If they lose that credibility and they're still talking taper this time next year and they haven't done it, no one's going to listen. It'll be 100% discounted.
Well, and you know, it's always been my thought that these economic reports that come out every day, every week, are manipulated, right?
Of course.
We know that, and they kind of manipulate them. A lot of them are random surveys that are done.
First of all, they're inartful to begin with.
Right, exactly. But they put, but this is what Wall Street, this is what the markets pay attention to, are these reports. So knowing
correct, and what the Fed, as you say, and how the Fed will interpret those reports, not so much what's in the report.
Correct. So even if they say they're going to taper, right, and their intentions are, and they've told us what information they're looking at, there's nothing preventing these reports to keep coming negative if they feel like they're not going to gain anything by tapering. So
true, but the danger there, Ryan, is if everything is bad, then they lose credibility because now they're saying reports are bad, and QE doesn't work, but we're going to keep doing it.
Well, but that's why it seems like they're always changing their target, right? They're changing their target for unemployment rate. Like it's now down to 6% is where they wanted their target unemployment rate to be before they tapered. So they're always setting these moving targets because they know if they have to adjust them as time goes on because otherwise it would force their hand when these reports come out. But I'm really puzzled. I think what I really want to see is what happens once Bernanke leaves and Yellen takes her post, because we know what her views are.
Oh, she wants negative interest rates. But, Ryan, if they want to continue tapering, you and I are in 100% agreement that they want to and they need to, the best way to ensure that they can continue to taper is to toss out just one little symbolic taper, and that gives them all the ammunition in the world if it turns out to be a disaster to continue with quantitative easing or some other name of what they want to do to put money into the markets.
Well, that's why it absolutely probably will not happen in December, because it won't be on Bernanke's dime that the taper takes place and it's an utter disaster, right? I can see that this being something that they try out once Yellen takes her post, but as far as just this month around the holidays, I just don't see it happening. Interest rates have already been moving higher.
That's such a bad tone going into the new year, and it also could screw up the holiday season too. The last 5 shopping days.
Exactly. I mean, honestly, the Fed, they ignite things sometimes that they don't think they're going to, and around the holidays, it's already a very tumultuous market around the holidays, as we discussed on one of our earlier shows about why interest rates typically rise during the holidays. And if you guys haven't listened to that, you can always go back in our archives on iTunes or on the website at Real Estate 360 Live and check out the past episodes. But it's already rocky markets through the holidays, and to have them come in and taper on top of it, who knows? I mean, people are already getting out of their positions heading into the new year. I can only imagine what would actually take place if they did taper. It would be an interesting week or two headed towards January.
The only reason it would be done is if Bernanke was convinced that they need to do this taper and that he could sell the tapering is not tightening line, and for his legacy to say, look, we held it off, but on my way out, I started it, and then Yellen didn't continue with closing down the program. But I don't think so. I think he's in the same camp that it wasn't ready when he left. He'll write his book in a year or so about why QE lasted as long as it did, and he'll probably argue why it should continue in 2015 when he writes his book. So I don't think December is the time, but I really think that they have to slide one in at some point, because they can't keep saying It was close last month. It's on the table, then it's on the table. It just sits there on the table for 5 years. It kind of gets stale.
So I got a good question for you. So you remember when Greenspan was in office and we had that lower interest rate environment for such an extended period of time? We had the real estate boom and bust. And then after he was out, he wrote his book on his thoughts on it. What is going to be the book that Bernanke writes if he can actually tell the truth as to what was happening and why it happened 4 years later from now? What do you think he's going to say? You know, what's going to be his interpretation?
His interpretation is going to be he avoided the greatest depression of all time. He saved the system. He had to throw it on life support. Because it was so damaged, he had to keep it on life support. He saw positive signs, but there were other things that prevented the Fed. They're limited in what they can do. There was congressional problems. There was European problems. You know, there was global issues. But through it all, he managed to steer through his creative use of quantitative easing the U.S. economy and keep it on an even keel, and that the United States economy, by these objective measure numbers of GDP, is, you know, the strongest economy in the world. Now, that's because of QE. You screw up the economies of other countries, and all the benefits of QE come to the United States. Of course, the United States is going to have the best economy. But that'll be his argument, that he basically, through his, you know, stewardship, kept the United States from a disaster. His thing is going to be, it could have been worse if I wasn't there.
Right. Yeah, I mean, I can definitely, you know, see that being the case. I mean, and I think that, you know, only time will tell how this all plays out. You know, I brought up earlier about Harp 3.0, and I did want to touch on that just one more time because this is something that they've been trying to push through. The Federal Housing Finance Agency, who is the conservator of Fannie Mae and Freddie Mac, they have been trying to push Congress and the White House to push this through. There's active bills in Congress as we speak that they refer to it as the Responsible Homeowner Refinancing Act of 2013. Whatever the name of it is, Harp 3.0 or Harp 2.0, Harp 1.0, it doesn't matter. But the possible updates to this program are that homeowners can re-harp a prior Harp refinance, okay? Homeowners can Harp refinance a non-Fannie Mae or non-Freddie Mac mortgage, which I thought from the beginning was the biggest hang-up of this program, is because there's so many people that had alternative mortgages that they took out back when that were not backed by Fannie and Freddie. They were the stated income loans. You know what I mean? They were all those junk loans that nobody liked, no income, no assets. They weren't backed by Fannie or Freddie for the most part, so those are the ones that were upside down and couldn't get out of their loans. Number three is homeowners can Harp refinance a loan from after May 31st of 2009, and before that wasn't the case. Homeowners can Harp refinance a second mortgage with a first mortgage, so they can encumber a second mortgage where they weren't allowed to do that before. So these are all improvements to the market. I mean, like I said, part of the show is to bring you, if there is anything that can benefit homeowners out there, and this is something that should have been done from the get-go, Louis. Remember, I discussed this. I thought that if they really wanted to help everybody, they would have done this from the get-go. Now, I would have even taken it a step further. If they wanted to help people, if they really cared about helping the American people, they would have set it up. So the underwriting of these loans was so simple that it was just a matter of, have you always made your mortgage payment? Have you not missed a mortgage payment since you've taken it out? Guess what? There's no underwriting process here. All it is that we have to just get you to sign a new note and deed of trust, and you're out the door, right? It should be that simple if they really cared about giving people the interest rates, the lower interest rates. But
that's not what it's about.
It's not what that is. It's not what it's about. It's about saying that they're doing something. They're always saying that they're doing something, but in reality, this program, Harp 1.0 and 2.0, has been around for years now, and it only has helped about 3 million people.
Like, all the economic policies give lip service to helping the poor, the middle class, the underwater homeowner, when all the policies are designed really to help the banks and the moneyed interests. It's as simple as that. It's not like, they tell you with a straight face, we need to do quantitative easing because the employment situation still isn't good. That's nonsense. The reason they need to do quantitative easing is to help the government keep its borrowing costs low, which I suppose does help the poor and the middle class so we can afford to continue to pay entitlements. But really it's to help the banks to keep buying those garbage mortgage-backed securities and taking them off the bank's balance sheets. So it's an effective continued bailout of the banks. And, of course, they make money, the dealers, when they sell U.S. Treasury. So that's a nice little kicker for the banks. And also, to keep interest rates low, you give free money to the banks, and then they can get free interest rates. Even if what do they get, 0.8% or something?
Yeah.
But it's still that money that they get, it's free interest that the banks get. So the entire low interest rate environment helps the banks and it helps those that are indebted. And the banks are the ones that are most indebted and allows them to continue. It doesn't help the average person.
No, and it
helps us buy more stuff, helps put you more in debt, which gives them even more control over you.
Right. And speaking of the big banks, so we have the whole qualified residential mortgage rule, which is going to take precedent at the beginning of January 2014, which is going to change qualifying ratios. I have since read some reports that there's two or three people, bigwigs. I think one of them is the CEO of Citi, that has come out and basically expressed interest in opening up an alternative lending institution. I want to say it was called like Orchard Loans or something like that. And what they're going to do is create alternative financing that's outside of the qualified residential mortgage rule. So isn't it interesting that now the Fannie and Freddie have come in and they've said, well, guess what, guys, we're only going to buy loans that fit these guidelines, and it'll basically make you pretty much it'll be hard for people to come after you and try to sue you for wrongful doing. And now on the other side, they said, you know what? Well, now I see that there's a need for financing for these people that have ratios that are higher than 43% of their income, and we were already giving those mortgages out anyway, so why not create another company that we can lend out? And do you think, Lewis, that they're going to be lending out at higher interest rates on those loans?
Of course.
So they create their own markets, and this is where, it was only a matter of time, Lewis, and you and I talked about this before we started to move back towards there has to be some sort of alternative financing out there. And but
Brian, it's still distorted because there's the government-sponsored market running parallel to this private market. And the government-sponsored one is far larger, and the banks make a fortune on that one. And then what they're not allowed to make, well, they'll go out and they'll do it in the private market. But those rates the whole thing is distorted because of the massive government intervention in the market.
Oh, absolutely. I mean, everything in real estate right now is completely distorted, right? I mean, we can't, and I think this is a frustration that many of you may have out there if you're even looking now to buy a house or to sell a house, is that you can't tell what's what, right? And
right.
If you listen to us every week, I mean, we're pretty much breaking down what we think is going on. We don't necessarily always know for sure what's going to happen. And if you're trying to make a decision whether you should buy a house or you should wait for the beginning of the year, if you think interest rates are going to do one thing or versus another, you can't. You can't figure this out. Unless you're sitting in on the meetings with the Fed, you would not be able to know what's actually going to take place.
Right.
So and that's why I always say that the most important thing that you can do is just look at where you're at today. Don't worry about what tomorrow is going to bring. And if you're comfortable with locking in and you can qualify for your mortgage, you can afford that house today based upon everything that we see today, then you should move forward knowing that. If, let's just say for some bizarre reason, interest rates were to shoot back down instead of in the mid-4s, they go back down to the mid-3s, you always have the ability to refinance. Don't beat yourself up if the markets get better by an eighth or a quarter. I mean, you couldn't have timed that. And I think people think that they're in the business of trying to make sure that they get the very best interest rate all the time, and it's impossible for people to do that. It is.
These rates are a gift, Ryan, no matter how you look at it.
They are, and I think that
whether you get a bigger gift and a lower rate or any gift, there's a gift here in these low interest rates courtesy of the Fed.
Exactly, and I think that most people.
But that's also driving the home prices higher.
It is driving the home prices higher, and I think that most people, though, they don't even really look at it as a gift from the Fed because they don't even understand why they're that low, right? they've just been conditioned that they've been that low for a while.
Right.
So everybody's come to expect that they should stay low. And who are they going to get mad if they go higher? They're going to blame it on the government. They're going to blame it on Congress. They're not going to blame it on the Fed, because half the people that I talk to don't even know that the Fed's the reason why they're low, right?
Oh, Ryan, economic ignorance is why we have all these bubbles and things are being able to be manipulated. Bitcoin is an example. Why would people believe in a computer mining game that you can actually fake mine value by getting Bitcoins, and if people are going to accept them, it's because they don't understand money. It's the same with the Fed. They don't know what the Fed is. They don't know what interest rates are a result of, money supply and the cost of money. They don't understand any of that. They just know there is an interest rate, and maybe they think someone sets it, which is already a misnomer. Interest rates shouldn't be set. They should be market-driven. But on top of that, it's basically a little knowledge is a dangerous thing. Most people don't even know anything about the Federal Reserve or anything about how markets work. They just see what they understand are things, prices go up, and they understand what they have to pay. So when an asset goes up, they want it. When it goes down, they don't want it. That's like Bitcoin. If home prices are too expensive, that's all they understand. If they understand interest rates are low, that's what they understand. They don't know why they are. Right. So it's very difficult for people to make informed decisions, because the only decision people make is based on what the price is now and where they think it might be going based on what they hear.
Absolutely. And see, the only way that you could even really make an educated-based decision is to actually know what's going on with the Fed, because that's really all that matters.
That's 100% of the market, and people are unaware and ignorant of how it works. You don't have to be for or against the Fed. I'm not talking about people who have it in their heads that the Fed is the source of all evil. You don't have to take that position to understand the Fed. You probably will come to that position if you understood it, but still, you need to understand how interest rates affect the economy, affect home prices, affect asset prices, and how interest rates are derived. And it all goes right back to the Fed.
Yeah, and it hasn't always been that way. And it's since the Fed has stepped in and they've started these crazy mortgage-backed security treasury buying programs.
Well, they've always been influential, but they've never done this monetization of the debt.
Absolutely. And since they've done this, I mean, because in a regular market or in a free market where there wasn't as much manipulation, right now interest rates would be at a minimum of probably 6%, right? At a minimum, if not higher than that. And the fact that the economy is struggling, was struggling, continues to struggle, they figured that to be able to keep interest rates low, it would help boost consumer confidence. It would help home prices rise back up again. And in the end, they were really just protecting the banks.
Right, that's the story that they tell you.
Exactly. They're protecting the banks because they wanted to get the banks' asset prices back up higher, right? They had all these foreclosures and REOs and bad assets on their books, and they needed to be able to get those prices higher so that these big banks wouldn't take a bath. Then they let the big banks borrow money at next to nothing. They reinvest in the stock market, makes tons of money. It's all about them. It has nothing to do with us. So now you're probably saying to yourself, well, why do we care about all this? Well, you still need to care because you need to know what you can do in your individual situation. If you're looking to buy or sell a house, if you're looking to potentially invest in the stock market, you still need to understand these things because you might not have enough money to have any sort of say with the Fed, but you can try to protect what you do have, right?
Right.
And I think that's the critical thing to understand is that you don't want to necessarily lose, your house or money that you have saved up because you're just not paying attention to what's going on. Now, I can tell that, I talk to a lot of people that really could care less about what's going on, and they just feel like whatever's going to happen is going to happen. And, well, that may be true. I still want to try to position myself that I'm on the right side of things. And being able to take out a 30-year mortgage at an interest rate of sub 5% is an unbelievable idea. If you plan on buying in the next 2 to 3 years, you should consider doing that as soon as you're financially ready and able to do that.
And you're planning on staying in that house too.
And you're planning on staying in there because you're actually protecting yourself against what the Fed has been doing.
Yeah, you're protecting yourself against rent increases, mortgage increases. If you can afford to pay $2,200, $1,800, whatever the amount is a month, now and you're locking that in for 2, 3, 4, 5, 6, 7, 8 years for the time you're going to be in the home. That's a nice thing to be able to do economically.
Yeah, and it's no coincidence that, there's been investors and hedge funds and everybody else that's been running to take advantage of real estate. They haven't been running to take advantage of real estate just because home prices are rising. It's because they're able to borrow cheap money.
Right, and then get a return on it in the form of rents that are higher than the amount of money that the rate at which they borrow it.
Yeah, so when we get back to markets where there's less investor saturation, we don't have, like 30% of real estate transactions that are going out in cash, and we start having more people that are just out there buying houses regularly as their primary residence. They have to get a loan to do that. That would really give us a true sense of,
when are we going to have that, Ryan?
It's not going to be anytime soon.
Right, because you don't have the jobs there and you don't have the income growth to support it.
And that's
and the investors are still there.
Yeah, and that's also another reason why, as you had said, it would make sense for them to taper to actually push interest rates a little bit higher, so that it didn't let property values spike up too much. Because if that happened, then you'd start to see more of those underwater people put their house on the market, but there wouldn't necessarily be the buyers for them.
Right.
And so I think that all these little things factor into the Fed equation when they're trying to mastermind what their next step is. I just think that they really don't have any place to go. It's either make a taper and then after the fact realize they probably screwed up and come back over the top instead of doing $40 billion. Then they start buying $50 billion to try to make up the difference. I mean, this is going to go on for some time. It's just a matter of when will it implode. Your guess is as good as mine, Louis. We've been 5 years into it. Who knows how much longer? But when we do have people that are now buying into these basically virtual currencies, and we start to see that type of stuff, it is kind of scary.
Well, right. You think about what Bitcoin is. It's a joke. You and I can invent what they're saying is it's limited in supply. They just invented what the limit supply is. You and I can invent a currency based on how many beers the Dos Equis man drinks in his lifetime. Well, there's a limit to that. And you're going to base something off of an artificial limit? How many times Ryan runs around the block in a 3-day period? Well, there's a limit to how many times you can run around the block. Sure there is, but there's no economic value in having you run around the block or having some guy drink beers any more than there is in people wasting electricity to try to mine Bitcoins out of a system.
Yeah, it's not tied to anything.
You know what the argument for it is? Well, neither is the dollar. Okay, right. Lesser of two evils. But that still doesn't mean people are thinking we need sound money. They're saying we need anything but money that could be printed into oblivion. So if there's some kind of artificial restraint on it, that's better than the dollar, which really is nonsense because the dollar is based on you have to pay your taxes in dollars, and there's the force of law behind it. There's no force of law. I'm not saying it's a good thing, but it's very effective to have the force of law behind your currency.
And in a virtual currency, it's
you choose to pick it, and the reason people don't choose it is because it's going up. They'll not choose it when it goes down.
And it couldn't possibly be sound money to choose that anyway because of the crazy fluctuations that currency has, right? I mean, it's absolutely crazy with those numbers. One day it's 60, next day it's a couple hundred. I mean, it's insane. That to me is more of, I don't know, I almost feel like that people are just investing in that as some sort of investment, you know what I mean? Thinking that people are just going to keep going into this currency.
Why put your money in the bank? Why put your money in the bank if they can take a portion of it and it might not be there? You might as well throw it into an artificial mining game that goes up.
Crazy to think about, but that's what it seems to be.
Well, that's what it is. Money in the bank used to mean it was safe. Now it means they can take it from you. So you start to believe in things like artificial currencies, cryptocurrencies. You start to believe you're a new adopter, you're cool, you're hip, you understand it. Yeah, I understand it. They invented a currency, and they convinced people to take it because it had these technologically advanced properties. So what? I mean, anybody can invent a currency now, as long as you convince enough people to take it. Well, but that's all it is, Ryan, because it says, well, you can transfer money to Argentina. Well, how many people need to transfer money to Argentina? Or you can get it with you on a plane when you can't take your $500,000 worth of gold on a plane.
Right.
How many people have $500,000 of gold that they need to get on a plane and get to Uruguay?
Well, and through all of this, through these virtual currencies, Fed manipulation of interest rates, all this stuff, and we're sitting here looking at silver, gold at still very, very, very low levels, right? I mean,
when you have these speculative bubbles, people overlook real value, always. In the dot-com boom, gold was at the lowest rate ever. Because you're kind of an idiot to hold a real asset when fake assets are rising at triple digits.
Exactly. It's just knowing, it's being ahead of everybody else before the meltdown starts. And I think that's what's coming. I mean, obviously...
It always comes later than you expect. But look at how long the dot-com bubble lasted.
That's true.
Went from 95 to 2001, 2000.
Right, and they're saying that the stock market at 16,000+ is not, we're nowhere close to topping out. I'm like, how like the fundamentals behind these companies, it's absolutely amazing. I don't know if you were watching that 60-minute special, but they were basically showing, we talked about this a little bit about the Amazon drones that are going to deliver things to people.
Yes, I saw that.
Amazon spends billions and billions of dollars in research and development. Amazon, if you actually look at their numbers, they're not making much money. Well, they can't make much money when they're selling things at the very bottom of the barrel, right? But when they can continue, everybody buys into Amazon as like basically they're the ones that dominate basically online marketplace. So their stock price just keeps going through the roof. They've got more money than they know what to do with. It doesn't mean that the company itself is doing that well.
They're not. The only defense you can make of Amazon is that if they wanted to, they probably could raise prices, not lose much market share, and actually be profitable. Now, they wouldn't be profitable to support the valuation that they have now. But the thing about Amazon is it does have a massive adoption and goodwill with customers. But some of these other companies have no way of ever making money, don't even have goodwill, and people are just buying them because they're going up.
But they actually asked the CEO of Amazon, would he raise his prices, and he said no.
He said no, right.
Which is,
Well, as long as Wall Street's willing to believe that there's value there, why would he? They're rewarding him for giving away goods and services.
Yeah, and he has enough money to spend time on figuring out how to eliminate more humans, right? So, he's a direct beneficiary
of a bubble economy because while the average retailer is trying to figure out how to make a gross margin and a net profit this Christmas season, he's thinking, how many billions more can I sell? Yep. It doesn't matter how much it costs me to sell more.
Yeah, he's got a...
How can I delight customers? Well, the way you delight customers is give them the lowest possible price or even give them free stuff.
Yep.
But it's hard to afford that if you don't have billions of dollars of public money that are driving your stock prices higher.
Yeah, it's not a regular business model for most people. I just think, and he's talking about that technology of the drones is like 2 or 3 years down the road. So, I mean, they're not even really close. They've got enough money to blow for the next 2 or 3 years to figure it out. We're coming up on the end of the show, but I do want to touch base on a credit tip for this week. The Credit Pros is a legal credit repair company that I personally send a lot of my clients to when they're having issues getting their credit raised up to levels that they need to qualify. Obviously, it's difficult to get a loan, but credit's one of the main reasons that stops people. And this week, the credit tip from the Credit Pros is actually on debt settlement. Many people, when they have a lot of credit card debt, you always hear, I'm sure you hear these tons of commercials and advertisements about contact these debt settlement companies. They can settle your debts for pennies on the dollar. Mm-hmm. Well, I think, and they bring up a fantastic point. Like, it's a great thing that it looks like, oh, great, I can settle my debt. But what happens when you go to a debt settlement company is they actually look at these things as almost you're going through a bankruptcy, right? Because you're basically shorting these creditors and lenders money, which is the same thing as basically what would happen if you went through a bankruptcy and they didn't get anything. So when you do that, and a lot of the debt settlement companies will advise you to stop making payments, stop paying your bills. Well, what's going to happen when you stop paying your bills and all your credit card accounts? It's going to give you negative ratings on all those accounts. And then it's going to probably show, for the most part, almost most of the companies all put it in there, it'll say account is in consumer credit counseling. The minute that goes in there and that rating goes on that credit report, you might as well have just had a bankruptcy happen. Okay? So while it may seem like a great idea when these companies advertise this stuff and you're in credit card debt up to your eyeballs, you still want to make sure that you're making the right decision. And many of you might not have another option.
Right.
But at that point, you're better off to actually go and talk to an attorney about potentially going through a bankruptcy versus doing that, because it's going to have the same net effect.
Well, then also you get to extinguish or reduce your other debts, not just your credit card, because you don't want to have that and then 6 months later have to do bankruptcy anyway.
Absolutely. So, I mean, I just thought that it's a very simple tip this week, but, I know a lot of people have a lot of debt that's out there, and you're contemplating what you're going to do. Everything that we tell you about credit, remember, you may not be looking to buy a house now. It may not be
you never know.
3 years, but you never know. And if you're actually taking the steps now and you understand why these things are the way they are, why credit reporting agencies report certain things, how they report them, and what you can do to set yourself up to be in a position to where it doesn't hurt you as bad or at all, then you're going to be ahead of most people.
I have a question for you for next week, Ryan. Maybe you can get to the credit pros. Is it possible to negotiate directly with the credit card companies for a reduction in your payments?
Absolutely. You don't have to go through, any sort of debt settlement company. However, most of the time, and this is just from my knowledge of people that have tried to do it, is that they most of the time will require you to be late and show some sort of ability not to repay, right?
Right.
So that's the only hang-up. But, yeah, you can do it yourself. It's not mandatory. These companies, these debt settlement companies, they like to think that they're the only ones that can accomplish this, but that's not the truth. So, it's out there. But that's the credit tip. So if you'd like me to put you in touch with the credit pros, all you have to do is reach out to us. Go to our website, realestate360live.com. Like I said, check out our podcast on iTunes. Just type in the search of Real Estate 360, and you can download the podcast there. Louis, I appreciate you coming on. Let our listeners know where they can check out your blog, where you put up some great blog posts every week.
Sure. I'm at smallgold.com, SMAULGLD. You can visit there. There's a blog post up every couple of days on the economics, gold, silver, and real estate.
Perfect. I appreciate it, Louis.
Thanks, Ryan.
Guys, thank you for tuning in again. If you have any questions for us, you can always go to our website, realestate360live.com. There's an Ask a Question button on the right-hand side. We'll be back again next week. Take care.